Hello and welcome everyone. Welcome to another session, a YouTube session, which is meant for all the students, whether they have enrolled for any specific uh, course or not. So before we start with Keynesian theory, that we'll continue from the previous class that we covered yesterday with regard to the two-sector model, I'll have an announcement to make about the CA Iconic program. Now, this is a flagship program provided on Unacademy platform in uh, collaboration with Yashas Academy. All right. Now, what is the benefit of this program? Obviously, these are the benefits that you can easily find out. There'll be personal one-to-one coaching. There'll be doubt solving session, evaluated test series, printed books, and industry expert sessions will be there. There'll be on top of that Discord group wherein you can discuss every topic that has been discussed in the class with the faculties and with your peers and other students. And obviously there'll be weekly tests, study material will be given, and unlimited access will be there. So it cannot get any more personal than this, wherein you are interacting with the faculty on one-to-one basis, clarify all your doubts, and you can get customized study material. All right, article guidelines will also be provided. Now, as far as test series are concerned, three stages, series for every attempt: 40%, 80%, and 100%. All right, so it means at a three-stage test series for every attempt, 40%, 80%. Now live test on 40, 80, and 100% of the syllabus completed. It means as we go on completing the syllabus, after we complete first 40%, there'll be test series conducted. Then at 80% completion, and then there'll be full-length test series that will be conducted to you to figure out whether you have prepared or not. And it will be, every test will be followed by detailed analysis of the test paper, the question paper which has been given to you, and personal guidance and the feedback will also be given to the students. All right, as far as Iconic subscription is concerned, so you can use Yashas, you have to use Yashas Live. This is the code wherein if you use it, you will get a significant amount of discount. If you take for 12 months, you'll get a discount of 36%. So per month cost will come to 3188. For 24 months, it will be 2583. And for 6 months, if you take, it will be 5000. Clear? And obviously for every course that you take, whether it's foundation for intermediate, you can go for a combo as well. You have to use Yashas Live. For 24 months, combo plus CA intermediate, it will be 2750. All right. On top of that, an important announcement, a very important thing which is coming up, this is an intermediate notes and scholarship program, and with a pool of 1 crore rupees. All right, so please enroll for free right now, and this is a part of the mega combat. And please do not forget to use the Yashas Live code in every subscription that you take in order to avail the discount. Clear? But for this scholarship program, the registration is free. You can enroll for free. So what you're waiting for? You can download the app and start studying. So let's continue with Keynesian theory of national income, where we left yesterday. Now, as I've told you, in a two-sector model, remember I have mentioned that under Keynesian model, the equilibrium is always determined now at the point wherein aggregate demand is equals to aggregate supply. So if I have to talk about equilibrium, that will be the point wherein aggregate demand is equals to aggregate supply. We say AD equals to AS, and we know that AD is represented by what? Consumption of consumer goods and consumption of investment goods that we have already discussed in detail yesterday, and aggregate supply will be production of consumer goods and production of investment goods. All right, clear? So remember one more thing, that national income under Keynes model, whether it's a two-sector model or a three-sector model or a four-sector model, is always measured at the point of equilibrium. This you have to keep in mind, that national income is always measured under Keynes model at the point of equilibrium. So national income you see under Keynesian model is always measured at the point where aggregate demand is equals to aggregate supply. Keep this in mind. Alright. So aggregate demand equals to aggregate supply. Now let's look at a table here. Alright. Let's look at a table. You see, this table I've devised so that you can understand where and how the equilibrium happens. So investment we have taken as autonomous investment, which remains fixed, assumed to remain fixed at rupees 50. Autonomous consumption is 25, and marginal propensity to consume, which is nothing but the proportion of income that you spend on consumption, that is 0.5. And this side we write it as C plus S rather than CS, C plus S. Alright, that is the income side, and A plus aggregate demand side, this is the expenditure side. Alright. Now when the income is 0, remember I have told you that when income is 0, then the value of C will be equals to A. Let's say we have done this example yesterday. What did I tell you? That when income is 0, let's say Y is equals to 0, A is equals to 100, let's say. B is equals to 0.5. Now we know that aggregate consumption, which is denoted by capital C, is a summation between autonomous consumption, that is A, plus induced consumption, BY. So if I take here as A as 100 plus B, the value of B is 0.5, but the income is 0. So it means 100 plus 0.5, anything by multiplied by 0 will be 0. So you will get 100, that is the value of C. You see, the value of C is equals to value of A. So we have seen yesterday and this now also that when income is 0, aggregate consumption will be equal to autonomous consumption. So you see here, income is 0, alright. So value of C is 25, investment is 50. So aggregate demand will be C plus I, that is 25 plus 50, that will be 75. Now the thing is, when income is 0, how can I consume from the past saving? You will deplete your past saving, because I've told you we are humans, we cannot consume or survive by consuming 0 units of any commodity. It means we have to consume the necessities in order to survive. And we have also seen as income increases, the autonomous consumption do not change with the increase in income. That's why we call it as autonomous. It means the value of A will remain constant, but the value of BY, which is induced consumption, will change. So you see here, that's why you have A, value of A is 25 in all the cases, you see everywhere 25. So we have written 25, and I is also constant, so we have written 50 here all the way. Now B is 0.5, so where income is 50, don't you think 50.5, it means 50% of your income you are using on consumption, so that will be 25 here. So now the value of C is 25 plus 25, 50, plus I is 50, so aggregate demand is 50, 100. Then again same way here, 150 is your income, so 25 plus 75, that is 50% of 150, 75, and you are adding 50, so it means 100 plus 50, you get 150. You see here, at this point you come to the conclusion that aggregate demand is equals to aggregate supply at this particular point. But before this point, what was happening? If I compare the aggregate demand and aggregate supply, you see aggregate demand was more than aggregate supply. You see here 50 more than 0, 100 more than 50, 125 more than 100. So when the demand is more than supply, there will be pressure imposed upon the sellers to meet the demand, because suppliers or businesses, they're running the business for generation of profit. And if the demand is higher and the supply is low, it creates an opportunity for the sellers to produce more. But the thing is, when they produce more, they will use factor inputs from the household. In a two sector of income flow, we have seen that whatever the factor input is provided by the household will receive factor income from the firm in the form of wages, rent, interest, share of profit, or whatever. So it means when the supply is increasing, the factor inputs are taken from the household. So household are made factor payment. So don't you think their income is increasing? And when their income is increasing, don't you think consumption will further continue to increase and further demand will be created? So further supply will increase. So supply and demand both are increasing. But very soon what will happen? Initially supply was less, supply was increasing, demand was increasing, and then they will come to an equilibrium as it has been shown here. But after this point, what happens? The supply may breach the demand. So in that case, what will happen? The businesses will have unsold stock, but they will take time. It will take time wherein the business will reach from from a deficit supply to a surplus supply and crossing over the equilibrium. It will not happen in one day. Over a period of time, it will happen. So now you have a situation wherein aggregate supply is more than aggregate demand. You see, if you compare this, all right. So the point of equilibrium will be the point wherein aggregate demand is equals to aggregate supply. Now let's look at a diagram. What kind of diagram will you get when you're talking about aggregate demand and aggregate supply concept? You see here. Now in this diagram, you see along the y-axis, this is the y-axis, all right, this is the y-axis and this is the x-axis, all right. Along the y-axis, aggregate demand or consumption expenditure is shown. This y-axis shows consumption expenditure. Demand side is the expenditure side, because when you're demanding, you're buying some commodity, you're incurring expenditure. You're consuming consumption of consumer goods and consumption of investment goods. So supply side will generate revenue in the production and sale of these commodities. So income side here. Along the x-axis, this is your income side. Alright, along the y-axis, along the x-axis. Now you see the aggregate supply curve, it's starting from the 0 and it's making a 45-degree angle. Why it is making a 45-degree? When any curve makes a 45-degree angle, and that it will divide the area between the x and the y-axis into two equal halves. Because under circular flow of income, what did I tell you? That income will be equals to expenditure. So one half will explain the income, other half will explain the expenditure. And they should be circular flow of income. We have seen that factor income earned by the household equals to factor payment made by the firm equals to value of the output equals to consumption expenditure incurred by the household and equals to revenue income received by the firms. So circular flow of income is completed. That's why this makes a 45-degree line. This is your aggregate supply curve. All right. Now you see here the consumption line initially shows this one. So what is happening at the consumption line? What is happening here is that it will intersect here, but only consumption will never determine the aggregate demand. Aggregate demand is a summation between consumption of consumer goods and consumption of investment goods, correct? Consumption of consumer goods and consumption of investment goods. So it means this aggregate supply, this aggregate demand curve, this shows C plus I. All right. Are you getting an idea about it? So when I add I to C, that becomes C plus I. Now you see these are parallel lines. C and Ci are parallel lines. Why they are parallel lines? What is the reason that they are parallel lines? Tell me. Just hold on. Is getting stuck? Just network is fine here at my end. Okay. Why is it that you're getting the parallel? Because the investment is considered to be autonomously determined. It means in the short run it is assumed to remain fixed. In the short run it is assumed to remain fixed. So when you are assuming it to remain fixed, it means the distance between C and C plus I, difference between C and C plus I will always be constant. So I was 50, 50, 50 in the previous example we have seen. So I always remains constant. So it means the difference between C and I will be the constant, Now you see here at this point, at point E, we can say that aggregate demand equals to aggregate supply. Aggregate demand is equals to aggregate supply. We can say that aggregate demand equals to aggregate supply. Why? Because there is an interaction between the aggregate demand curve and aggregate supply curve. So this is your aggregate demand curve and this is your aggregate supply curve. Alright. So they are mixing here. Now before this, if I compare, you see this is the aggregate supply, sorry, this is the aggregate demand. Let me use a different color here. Let me use red here. So this is your aggregate demand and the blue line, let me use different, the blue line is the aggregate supply. So don't you think at this point, I mean before the E point, you have a situation wherein aggregate demand is equals to aggregate supply, in that the gap is breached, because as the demand is more than supply, the supply will try to match the demand. Alright, and as the supply increases, income increases. So income increases, consumption will also increase, so aggregate demand will increase also. So at this point you got, this is your consumption expenditure and this is your income that you are generating. Clear? So here we can say that income is determined at y0, because national income will be determined at y0. Why? Because the reason is that at this point aggregate demand is equals to aggregate supply. So I have told you that under Keynes model, national income is always determined at the point where aggregate demand is equals to aggregate supply, isn't it? And that's what you see here, correct? Beyond this point, what happens? If I further extend this line, you see this is the aggregate supply line, the blue curve, blue line I'm extending, and again this is the aggregate demand. So now you see that aggregate demand is lower than aggregate supply. So it means supply is in excess of demand. So sometime the suppliers will reduce their production, and when they reduce their production, it means supply will decrease and demand will also, because supply is decreasing, people will lose their job, their income will decrease, their consumption will also decrease. So demand and supply both will decrease. Again they will achieve equilibrium at some point in time. So equilibrium will continue to happen in the economy, and again the economy will move into disequilibrium. So whenever the equilibrium is achieved, we will measure the national income at that particular point in time. Alright, so here the national income is measured at y0. National income is measured at y0 because point E denotes the point wherein aggregate demand equals to aggregate supply. Beyond point E, aggregate supply is more than aggregate demand, and before point E, there will be aggregate demand more than aggregate supply. So both of these points, that is point beyond E and point before E, are the points of disequilibrium. There we don't measure national income. Alright, one more thing, that do you think that at point of equilibrium where we are measuring national income, full employment is happening, or can there be a situation wherein there is less than full employment? The answer is that yes, obviously they cannot be more than full employment. Alright, either you can, the economy will be producing at the full employment level. When I say full employment level, it means if 100 people are willing and able to work in the economy, they all are working to their full capacity. Or 100 out of 100 people, only 80 people are working, but still the economy achieves equilibrium. So equilibrium, keep that in mind, equilibrium can be achieved at the point where there is full employment or there is more than full, there is less than full employment. So at the equilibrium where the national income is determined, there may or may not be full employment. It means they can be less than full employment as well. But tell me, if the economy achieves equilibrium at this point and at this point there is full employment, can production increase beyond this point? The answer is no. So output can be increased beyond E only when there is ideal labor resources. It means at E less than full employment is happening. At the equilibrium when there is already full employment, then production cannot increase or supply cannot increase beyond that point. Alright, and if the demand increases beyond that point, demand can increase. It will lead to increase in nominal national income, not the real national income. It means the addition will be not in terms of quantitative output but only in terms of price. It means the price level will increase. It will cause inflationary gap. That will again a discussion for later classes. All right, so if suppose a problem is given, let's say there's a problem, very common problem that they keep asking here. So if suppose they give you consumption function, given consumption function, that is C equals to 100 plus 0.75 and Y is equals to 0.75y, A plus by, and I they have given autonomous investment as 1000. Then they ask you, the question is calculate equilibrium level of national income, and second, what is the level of consumption expenditure. It means what you have to find out, Y and capital C you have to find out. Now if you look at the empirical function, if you look at this function, if I write it as C equals to 100 plus 0.75y, don't you think I know that the value of A is 100 and value of B is 0.75? Alright, so we know that national income is always measured at the point of equilibrium. So can't I write here that when national income, that is Y denotes national income, is always measured at the point of equilibrium, at the point of equilibrium C plus I will be equal to C plus S, correct? Alright, so let's take the value here, because I value is given, so I'll not take C plus S, I'll take C plus I. If the value of C plus S is given, then you will take C plus S. So anyways, C plus I. So can't I write here, if I know that Y is equals to C plus I in a two sector model, I can write here Y is equals to C plus I. So C values I can write here 100 plus 0.75 Y. Can't I write it as, because Y is what? C plus I. So value of C This is the value of C. Alright, and then I have to add plus I. What is the value of I? That is 1000. So if I simplify it, 100 plus 1000, that will be 1100 plus 0.75 y. If I shift y to the left hand side, it will become y minus 0.75 y equals to 1100. Alright, so it means I can write 0.25 y equals to 1100. So y equals to 1100 divided by 0.25. So 25, it means 4 times, 11 into 4 times, that will be y equals to 4400. Alright, correct. So we got the value of y. Now don't you think it becomes easier to get the value of C? So C is equals to 100 plus 0.75 y. We know the value of y is how much? That is 0.75 into 4400. So how much it will be? That will be 4400 divided by 0.75. Into 0.75, sorry. So that will be 100 plus 3300. So that will be 3400 will be the value of our consumption. Very easy. Alright, very easy. Now let's understand the concept of investment multiplier. What is investment multiplier? You see, multiplier, if you say very general meaning of multiplier, it means something that multiplies and the aggregate outcome will be more than the initial introduction. Meaning what? You see, this investment multiplier is also known as ripple effect. Now you can relate this to, say, let's say there is a pool of water and you take a pebble, small pebble and stone and throw it in the water. The point of contact is 1, where the water, where the stone is hitting the water. But do you think the impact will be confined at the point of contact between the stone and the water? No. You'll find that ripples are spreading across the length and breadth of the pool. The same thing happens in an economy. When there is some change happening in one part or one sector of the economy, it will have significant implication on other sectors of the economy as well. So investment multiplier simply says that when autonomous investment increases, we assume that autonomous investment is not increasing, it's assumed to remain constant. But if I increases, maybe shorter it will not increase, longer it may increase, sometimes I will change. So when I is increasing through the market forces, I is increasing, investment increasing. That increase in investment, autonomous investment, will certainly lead to increase in income as well. Because when there is investment increasing in the economy, then obviously it will generate more opportunities for the people, so their income will increase. Now when investment is increasing, the income is increasing. When the income is increasing, it will generate demand. When it generates demand, demand will be met by the suppliers, because an opportunity is created for the producers to produce more, so they will start producing more, obviously provided they have already not hit the full employment level. If that is the case, then increase in autonomous investment will always cause inflation. But okay, So they increase the level of output. When they increase the level of output, don't you think they will require to consume more factor inputs? It means they will in the process generate employment opportunities. So it means they will create employment. It means it will increase income for some or many, and those people whose income has again increased, they will create new wave of demand. When a new wave of demand, the second wave of demand is created, then again further the demand will have to be met. So further increment in production, it means further new labor opportunities. So again income is going to increase and again demand is created. So it means it will have a ripple effect. The cycle will continue to go on and it will take various many turns. Alright, many turns. So what happens here, just like imagine a car is on a plane. Now 100 meters from the plane there is small, little by little the land is sloping down. Your car has malfunctioned. You push the car. Initially some effort you have to apply, but as the car comes to the slope, don't you think acceleration automatically increases? And more the slope, more the acceleration. The same thing is happening in the economy as well. Alright. So when income increases, say for example good monsoon, you must have seen, no, whenever there is a good monsoon, stock markets go rise. Now why is it so? The primary sector agricultural output will increase. How is going to affect the financial market? It will affect the financial market because primary sector is a part of the overall economy. So it means there will be bumper production, more yield, cost of production will significantly come down because material cost will come down. Goods can be sold at a lower price, demand will increase. When the demand is increasing in every sector, don't you think it will generate more employment? So initiation happened in the primary sector, but the benefit is reaped by the entire economy. Alright, clear. Likewise, if suppose there is more investment, autonomous investment in the secondary sector, don't you think the secondary sector, when they are more producing more, carriage inward and outward will happen, that transportation belonging to a tertiary sector. Packaging, distribution, sales, all goes to the to the tertiary sector. Businesses are making more and more money, they will go for buying insurance, they will take more loan from the banks. So it means initiation happened in the secondary sector, but the benefit is reaped by the tertiary sector, and very soon it will go to the primary sector. So this is what is known as investment multiplier. So what happens in this case, an increase in investment, autonomous investment, will lead to increase in income, but the increase in income will be in greater proportion than the increase in autonomous investment. Alright, that is known as investment multiplier. It means the income in the economy will multiply by a higher value, and the outcome will be that income is increases in a higher proportion compared to increase in autonomous investment. So how do we define investment multiplier? Right, investment multiplier is denoted by K first of all. Alright, so what investment multiplier says? It says that an increase in autonomous investment, that is I, will lead to increase in income in higher proportion. In other words, you can say, in other words, if the, or you can say, if there is an increase in the autonomous investment by rupee 1, the income will increase by rupee 5 if the value of K is equal to 5. Alright, clear. It means it shows as to by how much will there be increase in the income when the autonomous investment increases by 1 unit of a rupee. By how much? So it means if the investment multiplier value is 5, then an increase in autonomous investment by 1 rupee will lead to increase in income by 100 rupees. Increase in autonomous investment by 100 rupees will lead to increase in income by 500 rupees. So the multiplier, the value of the multiplier will determine the increase in the value of national income due to increase in the autonomous investment. So higher the value of multiplier, more will be the increase in the proportion of national income compared to increase in the autonomous investment. Alright, compared to autonomous investment. Now you see investment multiplier K, if I have to find out how we write it, change in income divided by change in investment. Change in income divided by change in investment. That is, we can also write it as delta y. Delta denotes change in income or change in mathematics, not income only, change in anything, divided by delta I. Clear? Delta I. So it depends how much is the value of the multiplier. Now also remember that the value of multiplier depends on marginal propensity to consume. Value of multiplier depends upon marginal propensity to consume. So if suppose, let's say that MPC, which is also nothing but B, is equals to 0. Let's say 4. Alright, and if you want to find out the value of investment multiplier, then the formula can also be written in the other way. I mean, the same thing you can find out through this formula. We write it as 1 by 1 minus MPC, or we write it as 1 by 1 minus B. Alright, 1 by 1 minus B. So if suppose if I write it here, K is 1 by 1 minus MPC, that is 1 by 1 minus 0.4, what you will get the value of A, sorry, not A, K, that is 0.6. So how much you will get if you divide 1 with by 0.6? You will get 1.667 or something. So it means 1 rupee increase in autonomous investment will lead to increase in income by 1 rupee 66 paisa. And as I've told you, there is a relationship between investment multiplier and marginal propensity to consume. Higher the value of marginal propensity to consume, more will be the value of multiplier, because you see, consumption is one factor that drives the economy. Keynes also mentioned that one of the fundamental cause of Great Depression that happened during 1930s in US and many of the European economies as well, it caught like wildfire. One of the fundamental reason was significant fall in aggregate demand. Businesses had unsold stock. They had to decrease their level of output. When they decreased the level of output, many people started to lose the job. When they lost the job, they decreased their consumption, because if they are not earning, how can they consume much? That led to again next wave of fall in demand, and some other business were affected, and it went so rapidly that it spread like a wildfire. and in no time somebody will say that 12%, somebody say 15%, somebody will say 25%. But even if I say 15% of the GDP of the world was wiped out in matter of days. In matter of days. Such was the problem. So he said that basic problem is fall in aggregate demand, because when people are consuming more, then they are creating demand, and if there is a potential for the economy to meet that demand, it will generate more and more employment, and that will again drive the economy, because again it will generate new wave of demand. So consumption, in a way, it promotes economic growth. So higher the consumption, more the level of income, and that's why you see the developed countries, the consumption level is very, very high. If you compare a citizen of India and citizen of US, a citizen of US consume 19 times more, 19 times more goods and services compared to a citizen in India. I'm not talking about rich people, I'm talking about our middle income earning families and compared with their middle income. Alright. So one of the fundamental reason is increase in consumption that will lead to, so multiplier effect will be higher if people consume more. So if I take or increase the marginal propensity to consume, that is B, from 0.4, so let's say 0.8, it means 80% of my income I am consuming, 20% I am saving. So what value you will get for A? 1 by 1 minus B or 1 by 1 minus MPC, that will be 1 by 1 minus 0.8, that will be 1 by 0.2, so the answer will be 5 times. It means now 1 rupee increase at autonomous investment will lead to increase in income by 5 rupee. It means national income will increase by 5 rupees or by a factor of 5 due to increase in autonomous investment. So what we have learned here is that they can ask you to explain the relationship, or a short question as well, explain the relationship between investment multiplier and marginal propensity to consume, or explain the relationship between K and B. So what we have learned here, you see that investment multiplier and marginal propensity to consume have a positive, that is direct relation. Higher the value of MPC, more will be the value of multiplier, and vice versa, right? But again, I've told you that marginal propensity to consume is there, but don't you think marginal propensity to save can also help us determine a the value of investment multiplier? Because when I write 1 by 1 minus MPC, K, when I write 1 by 1 minus MPC, don't you think 1 minus MPC is nothing but MPS? Because income can either be consumed or it can be saved. So I can also write here that is 1 by MPS. Now if you go to the previous here situation, you see, if I am consuming 0.4%, it means saving 0.6%. If I am consuming 0.8%, it means I am saving not percent, sorry. If I am consuming 80%, then I am saving 20%. If I am consuming 40%, then I am saving 60%. So if investment multiplier has a direct relationship with marginal propensity to consume, it will have inverse or negative relationship with marginal propensity to save, because when you're saving, then by that margin the consumption is going to go down, because income can either be consumed or it can be saved. So investment multiplier and marginal propensity to save have negative or inverse relation. Higher the MPS, lesser will be the value of investment multiplier and vice versa. Alright, and vice versa. Clear hai? Easy. So how can we figure it out from the diagram? Let's take a look at the diagram now. Now you see here again, this is the supply line. Let me color the supply line with blue color. Right. So this is the aggregate supply line, again dividing the area between the x and y axis into two equal half, making a 45-degree angle. So this is your aggregate supply line. Alright. And here use your income and aggregate demand along the y axis. Now here y denotes the changes in the national income. Now you see, if there is no multiplier effect, forget about this line for now. If there is no multiplier effect, then like in the previous diagram, only the thing is C is not here. If you have C here, then it will come to this point Y. Alright. So, but equilibrium is measured at the point wherein C plus I equals to C plus S in a two-sector model. So you are achieving equilibrium at this point, because at this point I can say that C plus I is equals to C plus S. Let me color this in red. Alright, just as in the previous diagram. Alright, so this is your aggregate demand and this is your aggregate supply. Alright, so this is your equilibrium level of national income if there is no change in autonomous investment. But when investment changes from I to delta I, it means if the investment was 500, now the investment is 750. So delta I, if it is 250, so now the aggregate value of C, aggregate demand will be not only C plus I but C plus I plus delta I, because investment was 500, now it's 750. So it means C plus I, that is 500, plus delta I, that is 250. Alright, so that means the value of C plus I will increase, and that's why this line shows the C plus I line. This line shows C plus I plus delta I line. And you see what is happening now. Equilibrium, after the I has increased, it shifts from E to E dash. It is shifting from E to E dash. Alright, it means at a higher level of income, equilibrium will be achieved when there is a rightward shift in the equilibrium. When the equilibrium shifts towards the left, alright, it will go down. Alright, so in that case the income is achieved at a lower level of income. So we can see here, due to change in the equilibrium or shift in the equilibrium from left to right, you see from E to E bar, we have a corresponding increase in the national income from Y0 to Y1. So now ignore this Y2 or whatever. Clear? So from Y to Y1. So this increase in equilibrium has led to this much increase in the national income. But what is the increase in investment? Now looking at the diagram, because now here you will measure equilibrium. Why now? Because now after the income has increased, now the equilibrium will be achieved at the point wherein C plus S equals to C plus I plus delta I. Because if I was 500 and delta I is 250, it means increasing by 250. It means I plus delta I, that will be 750 plus C. Alright, hypothetically I have taken this figure. So looking at the diagram, I can say that there is an investment multiplier. How can I say this? How can I say this? Very easy. You see here, if I compare the increase in investment, you see increase in investment is by this margin, correct or not? Autonomous investment is increasing by this margin. And if I want to find out corresponding increase in the income, do you think it is increasing by the same margin? You see, the increase in income which is shown along the x-axis from y0 to y1 is higher compared to increase in autonomous investment. If they would have increased by the same margin, it means there is no multiplier. It means there is no multiplier. Alright. And if there is a negative growth that is happening, then forget it. It will be below, then the increase in y will be lower than increase in the investment, increase in the autonomous investment. But we are talking about the normal situation now. So increase in y that we can see, that is increase in the national income, is showing a higher level of increase compared to increase in autonomous investment. So if I compare this area, that is the increase, that is the gap between C plus I and C plus I plus delta I. If I compare this gap and if I compare this gap, we shows the change in income. We shows the change in income as equilibrium increases from E to E dash. Don't you think this is way higher? So we can conclude here that as income, as how do you write, if suppose if they ask you to write or explain this thing, so how will you explain this thing? So initially you can write here like this, that I'll not write the full sentence here, we are running out of time. So initially what is happening? Initially equilibrium is achieved where C plus I equals to C plus S, alright, that is at the point E. And at point E, what is the level of income? Level of income is Y0, clear. Then what happens? Increase in autonomous investment, that is I, that happens. So now aggregate demand will become what? Aggregate demand will be C plus I plus delta I. Now the equilibrium, the new equilibrium will be determined at the point where C plus I plus delta I is equals to C plus S, alright, and this is denoted by what? By E dash, alright. So I can say here that equilibrium is achieved at a higher level of income. So equilibrium is achieved at a higher level of income, that is Y1 rather than Y0. So how we can find the investment multiplier, right? So we can see here it's very clear from the diagram that what? Increase in autonomous investment from I to delta I to also increases equilibrium level of national income from Y0 to Y1. Alright. The increase